Dollar yen remains in narrow range after several repeated upside attempts above 77, and each failed in sharp reversals, signal that the pair is currently remains in the broader directionless narrow range trading, as 77.00 offer currently initial resistance ahead of 77.27, 77.68 and 77.85 highs of the range, with only break above 77.85, 78 to signal a stronger break higher and the possible fresh direction of the pair. Meantime, the directionless trading within this range remains dominating at this point, and 76.40, 76.30 and Friday's low at 76.55 actually are the levels on the downside. Loss of 76.30 would signal further weakness of the pair and likely to open a way for test of record low of 75.93, below which would be very bearish and extend the broader downtrend from 85.50. Dollar Swiss is back to strength after a corrective attempt. Found the bottom at 86.46 on last week on Thursday actually, and fresh gains broke above the bear trend line drawn from 89.26, the main the recent high. Significant is that the market is back testing back to strength and testing 200 days moving average that has been tested already once with I would say false break higher and immediate reverse as the main trend line drawn of 10064 on 28th of November 2010 high capped the upside temporarily, and the subsequent reversal corrective pullback found the support at 86.46. Back on the hourly and 4-hour chart, we can see that break above 20 days moving average and test of 200 days moving average now is looking for a further extension, and test of trend line resistance currently at 89, above which would open 89.26, the previous high, and the open way for a extension higher into levels above 90. The near-term studies at this point remain supportive. However, 4 hours RSI is turning lower. We might see some corrective action at this point. Initial supports come at 87.92, which is the low of the day, and then we have the Friday's high at 87.75. However, the gains, the pullback above 87, reversal above 87.55 would keep the immediate bull tone in play and look for the further upside extension. Commodities are in opposite direction currently. As I mentioned in some previous sessions, that gold, the crude oil, remains capped at the 90 zone, as the recent attempts higher failed at 90.39 and 90.57, and the immediate reversal is now testing the main trendline support drawn of 75.70, the low of 9th of August. Now break of the trendline support would weaken the near-term outlook for the crude oil, with next level to watch at 85.15, which is the low of 12th of September, and possible extension lower down to 85.15 and down to 83.20 lows. Just to make the okay. Now we see that initially the 23.6% of Fibonacci retracement of the recent up move from 75.70 to 90.57 has been retraced. Holding above the trendline support might keep the, actually would signal bull trend from 75.70 still in play. However, the upside, as mentioned in earlier sessions, as the situation does not change. The firm break above 90 zone and 90.57 is actually required at this point to signal some further strength and the extension higher. As we also have on the daily the main trend line resistance that comes at 91.15. Ahead of this 90.76 is the 55 days moving average on the daily chart. So have number of obstacles to be cleared in order to resume the recent gains. Otherwise, might be break of trend line support and the test of 85, below 85 would signal an end of possible end of this corrective attempt and turn the focus lower as a part of the broader downtrend of crude oil. Gold is again regaining near-term strength after bottoming at 1762 last Friday. As we can see, the reversal from a fresh record high at 1920. We lost actually the initial support at 1790 zone, and this has weakened the outlook. Current bounce has a positive signal of breaking above the trend line resistance from 1920. The levels to watch at the upside around 1845. We need to see the gain of this level in order to confirm this near-term bullish action and refocus the upside levels. Otherwise, risk would remain on the downside and would be likely scenario of leaving lower top ahead of fresh weakness. On the downside, 1768 is the trend line support level, and 1762 the low of Friday, below which would again turn bearish and actually signal extension of the short-term downtrend from 1920. Our main support is at 17 zone, and this is a main short-term support, and below this one would turn bearish. On the daily chart, we can see it better, which is around 50% of Fibonacci retracement of the up leg from 1478 1st of July low up to 1920. So the risk remains more to the downside on the in case of a failure to regain 1845, and below 1762 we have immediate actually level 38.2% at 1751, and then we have our key resistance and key support at 1700 zone.